Brad Williams, Frugal Finance, estimating the stock deviation. Estimating the standard deviation of the stock's return is more difficult and more important than estimating the risk-free rate. The Black-Scholes model uses as its input the most current instantaneous standard deviation of the stock. In other words, the immediate volatility of the stock is the riskiness of the stock that affects the option's price. The Black-Scholes model uses as its input the most current instantaneous standard deviation of stock. In other words, the immediate volatility of the stock is the riskiness of the stock that affects the option's price. The Black-Scholes model also assumes that the volatility is constant over the life of the option. There are two ways of estimating volatility. The first method uses historical data, while the second technique employs fresh data from the options market itself. The second method uses option prices to find the option market's estimate of the stock standard deviation. An estimate of the stock standard deviation that is drawn from the option market is called an implied volatility. We will consider each in turn. Historical data. Estimating volatility using historical data, we calculate the price relatives, the logarithmic price relatives, and the mean and standard deviation of the logarithmic price relatives, letting P of R indicate the price relative for data T, so that P of R is equal to P of T divided by PT minus 1. We give the formulas for the mean and variance of the logarithmic price relatives as follows. P of R is equal to 1, and we're going to have some time, and it looks like some discounting. In other words, we have a continuous situation here. So we're going to have to probably discount something in the present value factor. We've got a log normal here. And then we have the variance. It could be P of R, and we have some time. And again, we're going to look at probably some continuance, some compounding using continuous compounding. As an example, we apply these formulas to data in 13.1, which gives 11 days of price information for stock. With 11 price observations, we compute 10 daily returns. The first column tracks the day, while the second column records the stock closing price for the day. The third column computes the price relative from the prices in the second column. That means the changes. The fourth column gives the log of the price relative, log. The last column includes the effect of subtracting the mean of the logarithm price relatives from each observation and squaring the results. So we have E33 minus 208, which is going to be 208. The last column includes the effect of subtracting the mean right here, of the logarithmic price relatives from each observation and squaring the results here. So we took E33 right here, this log normal of price, minus the mean and squared. The mean, variance, and the standard deviation that we have calculated are all based on our sample of daily data. We use the sample standard deviation as an input to the Black-Scholes model. 3 inputs to the Black-Scholes models depend on the unit of time. These inputs are the interest rate, the time unit expiration, and the standard deviations. We can use any single measure we wish, but we need to express all the 3 variables in the same time units. For instance, we can use days of our time periods and specify that time until expiration as the number of days remaining. Then we must also use daily standard deviations into a comparable yearly estimate. So we have estimated our daily standard deviation of 10 days. However, these are 10 trading days, not calendar days. We see that we are working in trading time, not calendar time. Deleting weekend days and holidays each year has about 250 to 250 trading days. We use 250 trading days per year. We have already seen that stock prices are distributed with a standard deviation that increases as the square root of time. We can change the timeline of our volatility estimate by multiplying it by the square root of time. For example, we convert from our daily standard deviation estimate to an equivalent yearly value by multiplying the daily estimate time the square root of 250. Annualized equals daily times 250, standard deviation. For our estimate of 0.21483, the estimated standard deviation in annual terms is 3454. So we take E47, the sample standard deviation, times the square root 250, gives us 34534. In our example, we've used 10 days of data. In actual practice, we face a trade-off between using the most recent possible data and using more data. In statistics, we always get more reliable estimates by using more data. However, the Black-Scholes model takes the instantaneous standard deviation as an input. This gives great importance to using current data. If we use the last year of historical data, then we have a rich data set for estimating the old volatility. Using just 10 days, as we did in our example, emphasizes current data, but it is really not very much data for getting a reliable estimate. To emphasize the importance of using current data, consider the crash of 1987 on Black Monday, October 19, 1987. The market lost about 22% of its value. If we used a full year of daily data to estimate a stock's historical volatility the next day, our estimate would be too low. In light of Black Monday, the instantaneous volatility has surely increased. Brad Williams, Frugal Finance, thanks for watching.